if I was someone who literally had no experience, I would probably start with like a 4 unit to a 10 unit in my local market. Be that terrible investor I mentioned in the beginning and be involved in the day-to-day, because doing that for a short period of time helps you manage the managers down the road, right? Like the more knowledge you have, it's easier to delegate a role once you've kind of done the role and understand it, because then it's harder for someone to fool you about what's needed. So if I were starting today and let's say I can't go do 100 units, I would probably go buy an 8 or 10 unit, maybe even here in California, right? Just so I can get that experience, get a track record started, and then move on to the bigger stuff.
Hey everyone, welcome to another episode of The Remote Investor. I'm Michael Album, and today I'm joined by the founder and CEO of Vantage Acquisitions, Andrew Cushman. He's an investor, he's a surfer, he's a skier, he's a dad, among many other things. And I get to chat with Andrew about what it's like going from flipping single condos to multifamily acquisitions and syndications. So let's get into it. Andrew Cushman, what's going on, man? Thanks for coming on and hanging out with me. I appreciate it.
Oh, you're welcome. Glad to be here.
I think we're going to have a lot of fun. Before we hit record, you and I were just chatting about how we're kindred spirits, ski people and surf people, but we're here to talk about real estate investing. So for everyone listening who isn't familiar with your story, give us the quick and dirty who you are, where you come from, and what is it you're doing in real estate today?
Yeah, I took the standard path into real estate and went and got an engineering degree. I knew that's not what I really wanted to do, but at least I'd have a decent paying job until I figured it out. So I was an engineer for 7.5 years. My wife and I tried a bunch of different little businesses that just seemed like probably harder work than our regular jobs. And then 2007, we discovered flipping, and we did our first one that year here in Southern California. We made as much as I made all year working at my job. So I said, that's it, I'm out.
One and done. You were sold.
Yeah, I was like, well, I got a year's worth of runway, right? So, I quit the job and went full-time into flipping. She left her job 2 years later. And then we did that full-time for a few years. 2009 and 10 were really good years. But then, everyone else started figuring out that there's a lot of opportunity there. And then also the problem with flipping is you don't have anything to show for it after the flip is done. Hopefully you do a good flip and you put a check in the bank, but then there's nothing left after that. You're only as good as your last deal. There's no there's no recurring income. There's no long-term wealth creation. None of that.
No tax benefits.
Yeah, exactly. No tax benefits. Actually, it can be taxed very highly if you don't structure it properly. And so we said, well, what's something that builds, more lasting income, more lasting wealth? Time generally benefits real estate. So what's something that benefits from longer hold periods? And then also, in 2010, we said, hey, we just had a huge recession, which means we're probably going to have a long economic expansion. A long economic expansion means household formation and job formation and rising incomes. And this is unique to that time, everyone and their mother just got foreclosed on and can't buy a house for the next 5 to 7 years, or they know someone who got foreclosed on and they're scared to buy a house for the next 5 to 7 years. So you put all those things together and we're like, man, the rental market looks like it's going to do really well. So we went and found a guy who had already bought 800 apartment units. We hired him as a coach to kind of hold our hand and guide us through the process. In 2011, we did our first one. It was 92 units on the other side of the country, out in Macon, Georgia. Been doing it full time since then. We're at about 3,200 units total, and it's been a great business. So
that's amazing. You said something here at the beginning that 2009 and 2010 were great time to flip, and when you said that, I was like, wait a minute, was it? Like, how is that possible? When everybody was getting foreclosed on and nobody was buying real estate, it seems like flipping would be the worst time to flip. So walk me through why that was such a good time for you.
There's no such thing as a bad market, just a bad business plan. So what and you're correct. There were condo complexes here in Orange County that in that couple year period, prices dropped 70%. Full on 70%. They went from selling at 500 to 150. But what that meant is especially in the first 2 years, there was a ton of equity in these houses, right. Most of them. So there was lots of opportunity to buy at a good basis and then fix it up and then sell it. But then also, too, we had no competition. Nobody was doing it, because I remember walking into a realtor's office with our second deal, the escrow office, and there's a realtor sitting in there, and he goes, "Are you crazy flipping in this market?" And I'm like, "Well, no one else is doing it, so yeah." Um, and then also, what we would do is, let's say, the day we're buying a condo, it's worth $400,000. We would buy it for 200, fix it up, and then go list it for 325 or something like that. So the idea is
Mm.
buy for 50 or 55 cents on the dollar, sell at 80 cents on the dollar. So even in the worst of the crash, as prices were coming down hard, it never took us more than 30 days to sell a flip, because it was the nicest house on the block or condo in the complex, and it was the cheapest one. So even though there was hardly any buyers out there, we got the one buyer that needed a house every time. So that whole time, we never lost money on a flip, and we never ended up holding one. Because we just adapted the business model to the circumstances. But again, by the time you get to 2010, everyone else kind of figured this out too. And it
Right.
was like, all right, now this is starting. Then competition grew. You had to buy at higher prices, and then all of a sudden it started getting more risky and more work. So.
Man, and this is amazing. I think because so often you hear flippers talk about wanting to just get maximum value for their property, and they price it at the top of the market because they want to squeeze out every last dollar possible. But what you're saying is, no, no, no. Let's price it appropriately. Let's make our spread and move on and go do the next one. We don't have to get every single dollar possible out of this deal.
Yeah, when you're doing a flip or trying to get a deal done, time is risk. So there's holding costs. You could have a flood, you could have a fire, there could be a war start. I mean, there's all kinds of things. And also, that was appropriate for that time in the market. Prices were going down. So the longer you held, the greater your risk. In an uptrending market, which we eventually transitioned to, I mean, I knew flippers who had things go. Actually, I take that back. Yeah, a partner of mine, a friend of mine, who we actually, he had a flip, ended up having a massive unexpected septic issue, cost $60,000 to fix. But because the market had turned and started rapidly appreciating, he still made a huge profit on that thing, because it was down in Tustin, which is the center of Orange County, right? So the strategy changes in that market. You have to adapt to that. Say, now I can pay a little more, and actually holding a little longer and taking my time actually benefits. So yeah, when we got to that part of the market, we flipped it. We weren't selling at 80 cents on the dollar. We were actually shooting for just a little higher than market, knowing that we'd probably get there, and we usually did. So.
Interesting. I love it, man. The other thing that's so interesting about your story is you went from flipping one unit property, single family homes and condos, straight into a 92 unit apartment complex across the country. So you're obviously on the Remote Investor podcast. So we'd
Mm-hmm.
love to hear stories like this. But I'm going to ask this in kind of blunt way. What made you think you were qualified to do that?
I wasn't. Part of it was just being too naive. But, I had talked to some multifamily investors, like local guys, who I remember this one guy. He was older, at least in his 70s, and he's like, "Oh, I would never do that." He goes, "Because I can't run over and fix the water heater." And I'm like, "You shouldn't be running over and fixing the water heater.
Right.
You're an investor. You hire somebody to do that part, who's
Right.
an expert at it." And so there's a lot of reasons for doing it the way we did. Number one, and just to make clear, we did not have the money for that. We went out and raised the money to do that. But the reason for doing it is, one, I live in Southern California. It's a great place to enjoy life: surfing, skiing, beautiful weather. It's a terrible place to do business. So my philosophy is, live where you love to live and invest where the returns are the best. So I live here,
Yes.
and we invest in places like Georgia, the Florida Panhandle, the Carolinas, Eastern Tennessee. And there's lots of other markets that would qualify, but we try to stay focused in one contiguous area. So that was number one. Number two is an easy way to solve the temptation to go get sucked into little details out of property is to make it so far away that I can't do that. Right. So now, with
Yes.
that said, I can easily be there in a day, because there's literally like 4 to 6 direct flights from LA to Atlanta a day. And
Mm-hmm.
I've done that. Like, been like, a new deal comes up or something, and I'm like, I want to be there the next day. Book the flight, and the next morning I'm at John Wayne or LAX. I'm in Atlanta 4.5 hours later. So it's not that hard to get to. But I'm not going to hop in the car to go look at a water heater. And then the reason we went straight from 1 unit at a time to 92 units at a time is efficiency of operations and scale. So when you're doing multifamily, it's really hard to manage a 10 or 20, 30 or 40 unit from far away. But once you get above about 80 units, the property will support efficiently a full-time on-site manager and a full-time on-site maintenance person. So that was another reason we went straight for 92 units, is because we can hire two people who will literally live on site and run this thing day to day. And then we just, I flew out on a regular basis, walked the property, met with them. We did, weekly calls. I mean, all kinds of stuff to manage the managers. But that's why we went straight to 92 units, so that we could staff it with our own people. And therefore, that's what makes remote management possible and effective.
Yeah, no, I love it. I love it. What about that interim unit count though? The 10, the 20, the 30 unit, and just go hiring a professional property manager. Why was that not a good option for you?
It's I should say, I don't want to discourage people from doing that and saying you have to go straight to 100 units, because that's absolutely not true. We just realized that, it's kind of like, I think it's Ben Hardy's book, 10x is easier than 2x.
Mm,
So that very much applies here. We could have gone and done a 20 unit, but now it's like, okay, we have to hire a management company, and then whatever employees are going to be managing our 20 units, it's not going to be their full-time job, right? They're going to have 5 other properties, and they're just going to not be focused on it. So like if we go 10x and go to 92 units, we can have our own dedicated people that report to us, and that
mm,
that we guide and give, and serve and enable and give direction to, which makes our job as asset managers, which is what you are as an investor, especially if you're bringing in other people's money, that much more effective. So, in terms of get a 20 unit or a 30 unit, that's far away. You can do that. You just have to find just the right management company. Also, the smaller you get, you tend to have, with some exceptions, less professional management options.
hmm
And so you have to watch them even tighter. Now, there are strategies to that, where let's say, you're like, hey, that sounds great, Andrew, but all I can put together is a 20 unit in another market. Well, you go get that 20 unit knowing it's going to be an extra headache in the beginning, but then over time you buy 4 more 20 units in the same area. Then you can hire somebody, you run them as one portfolio. And oh, by the way, 20 unit properties, all things being equal, trade for higher cap rates than 100 unit properties, which basically means they're valued less than 100 unit, even if the rent is the same and all that, because of the management issues and everything. But if you can collect a handful of them, put them together, and then sell them as 100 units, it will trade at that lower cap rate, which means you are forcing appreciation on those assets by taking them from kind of one a niche of the market, moving them up to one that's higher valued. And even if cap rates and the market stays flat, you can force appreciation by doing that. So there's just, again, never a bad market, just bad strategies. You just have to adapt. You can do it remotely with smaller units. You just have to, again, make some adjustments. And especially in the beginning, until you get good teams in place, wherever that market is, plan on going there on a fairly
yeah,
regular basis. Yeah.
yeah. Man, this is awesome. I can totally, so I'm an engineer too. So I can totally see those engineer wheels turning in your head about like how you're piecing this all together. Cause it makes so much sense. It makes so much sense. I'm curious, how did you land on the markets that you did? Like what took you to Macon, Georgia, as opposed to any other market that had 90 plus plexes available for sale at the time?
I mean, so I wouldn't buy in Macon, Georgia today,
How
because
come?
it's a flat to declining market. It's losing population. Income growth isn't very good. Job prospects aren't that great. It's not a bad market, but it's, we're looking for, if you you want to increase, you want to try to have as many ways to win as possible and as few ways to lose as possible. And one of the best ways to make sure you win is to own in an area that's seeing job growth and population growth. Population growth is number one. Like, people have to have a place to live.
Mm-hmm.
The last time I checked, Macon losing population. So I wouldn't buy there
But
today.
real quick on that note, like, because we're seeing Florida markets decline in price because it had so much population growth and all this overbuilding. So I don't want to derail where you were going, but how do you think about like oversupply in addition to population growth?
So oversupply, generally speaking, if the fundamentals of a market haven't changed, oversupply is a temporary situation that I generally see as an opportunity.
Okay.
So, like Austin right now is getting slammed because they got insanely overbuilt.
Right.
Rents are, have declined a couple of years in a row now. They probably still have some ways to go, but do you really think? But that all that building is going to come to a screeching halt by the time, sometime next year.
Right.
Do you think Austin is going to suddenly die and people are going to stop moving there and businesses
No
are going to
way.
stop moving there? No. So what's going
No.
to happen once all those new apartments are full and they're not building anymore?
Right.
Right, it's
It's the
going to
yo-yo.
shoot back up.
Yeah.
So most Florida markets I really across the country that you're seeing declines, it's similar. We're going to hit and just an absolute supply. I don't know what's the opposite of a wall, but I mean, it's just once we get, depending on the market, starting next year to 2027, the demand is even if we get into a recession, which I don't think the current administration is going to really allow that, but there's just not going to be enough apartments, and it's just supply demand 101. So I see, if you're a buyer today, I see the oversupplied markets as an opportunity, unless the fundamentals have shifted in that market and jobs and people are leaving. That changes everything. But if they're still
Okay.
coming in, so that's another thing. So how you determine that is check absorption. Most of these
Right.
markets that we're talking about, those new units are being absorbed, meaning people are moving into them at record rates. And so there's just, again, once the new units stop coming, now when you have this really high absorption, then what happens? Well, now you've got people fighting for more units than there are available, and rents just shoot back up. So,
yeah.
But anyway, so back to Macon, Georgia, how we figured it out. Nowadays we have a very strict screening process for markets and submarkets and where we will go and where we won't go. At the time, this being our first one, we just knew Atlanta and the Southeast in general was a good place to invest. People were moving there, business friendly, all that stuff we already talked about. And so, are you familiar with LoopNet?
Yeah, absolutely.
Yeah.
That's
So
where
basically,
everyone says good deals go to die. And I'm like, keep thinking it, because that's where I scooped up some great deals.
Actually, you know what? We picked up one of our most amazing 96 unit properties ever off of LoopNet because of that very thing. Everyone just said, there's nothing there. And most of the time there isn't. But because everyone thinks that, sometimes there is.
Right.
So anyway, so LoopNet has, at least at the time, had a map feature where you
they still do.
And so what we would do is, because I was doing all this myself. Now we have an acquisitions team, but I literally just started with LoopNet in Atlanta and then just followed the highways north, south, and east out of Atlanta. And I noticed there's this like one broker who had like 80% of the listings in Macon. And again, this is 2010 and 11 when, a property would get an apartment complex would get listed and sit there for months because no one could raise equity, no one could get debt, and everyone was terrified of real estate, right? So it's a very different time than it is now. And so I would just look at properties like this and then like make a list of like 15 of them and then fly out and then just go tour them all and make offers and all that. And so that's how, I think that broker saw a sucker coming from a mile away, like, oh, you're some California idiot, right?
You got deep pockets.
Yeah,
from California,
which actually wasn't true at the time. And we put a deal together. It was inexpensive. We bought it for basically $7,500 a unit.
$7,500.
$7,500 a unit. Yep. And we eventually a few years later we sold it for, how much did we sell it for? About 20 something a unit, I think. So it worked out well, but it was still a ginormous headache. And then, we learned our lessons and kept iterating and improving from there. So again, we wouldn't buy that kind of asset. We wouldn't buy that market, not even close today. But it got us started. So.
Yeah. Wow, I love it. So, okay, so getting back to this first deal you put together, I'm just amazed because you're doing it in a non-native market. You're doing a way bigger deal than you've ever done before, and you're raising other people's money in a kind of shaky environment. So, how were you able to juggle all those balls, so to speak? And maybe it's just because you're an engineer that you were able to slot things where they needed to go. But like, why would you want to take on so much all at once as opposed to chunking it and doing one of those things at a time and then on to the next deal?
Well, I mean, candidly, but before that deal, my hair was brown, and as you can see, that is no longer the case. That was one of the most intense, stressful 6 months of my life. We needed to, all said and done, we needed to go out and raise $1.2 million. And I candidly greatly underestimated um, how difficult that would be in that environment. And part of it was because when I got the deal, I had two investors who were both basically said, "Oh, I'm in," and they were going to take like 80% of it. And then turns out one of them wanted to be like a partner and control the deal. I'm like, nope. And then the other guy never even had the money and filed bankruptcy like a year later. It's like, what are you telling me? Yeah. So I
Huh.
learned about vetting investors for one.
Yeah.
So it took, we did extended the deal, extended the closing, got just enough to close it. All of a sudden, then it took a full 6 months to finish raising the entire 1.2. And actually, how we got it across the finish line is we went to the seller and said, "Hey, this property needs a lot more work than we initially thought," which was true. "We're not going to retrade you on price, but we want you to carry a note for a few $100,000, and then we'll pay you off when we refinance down the road." And he agreed to it. And so
Okay.
that was a big chunk of how we got it across the finish line. Because again, 2011, tough market, rough property, not financeable, right? So we're buying all
Mm-hmm.
cash,
Right.
but seller financing helped us get it across the table. So.
This is amazing. This is amazing. And it's funny. My first deal that I got way in over my head, I've also gotten since a lot of gray hairs for and a lot of heartache. But I'm curious, like you clearly learned a lot of lessons and that was your jumping off point. So, I mean, at the end of the day, are you glad you did the deal?
Oh yeah, absolutely. Now, with that said, I would tell people who are looking to get started or jump from smaller to mid-size or anything above that, resist the temptation to go buy the hard C class property. Yes, they're cheaper. Yes, there's less competition for them. Yes, they're easier for you to get a deal on, but there's all very good reasons for that. If I could do it differently, like if I was starting today, and let's say I could go buy 100 unit, rough class C property, I would probably say, you know what, I'll start with a 50 unit class B. Because when we look back over the 30, like 3,200 units in the last like 15 or so years, our best returns and lowest risk, so your best risk adjusted returns, were the class B stuff. Uh,
Mm,
and even to this day, like our properties that take the least amount of work and produce the most amount of cash flow are our Class B assets. We don't really own too many Class Cs anymore, actually, but because we purposely sold those off when things got really heated, thankfully. So I don't regret doing the deal because I probably wouldn't be talking to you today. And again, we learned stuff and iterated, and it started things go, and it still worked out great. Like I said, we sold it for two and a half, three times what we bought it for. But I would definitely recommend try to start off everybody, anyone starting off or moving up, go with a little bit better class asset. The Class C always looks better on a spreadsheet, but
yeah.
there's a big difference between making a spreadsheet and executing in the real world. And like what I like to tell myself is like the grass is always greener over the septic tank, and that's how I see hard Class C. So.
Yeah. No, I think that's great advice. I think that's great advice. I'm curious, like, how are you seeing the market today, given where interest rates are, given where prices are, just where we are in the market cycle? What is it that you're doing, given where we are?
Yeah, I mean, most multifamily on average is down anywhere from 20 to 30% from the peak. I would call the peak the first quarter of 2022. In terms of pricing, I think most markets are bumping along bottom. It's hard to see much real further downside. Some exceptions to that might be that Class C stuff in more rural or tertiary markets where there is, or actually even some urban markets like certain swaths of Atlanta where I think some of the rougher C class areas may have some more room to go down because there's both financial stress on the debt side and there's operational distress. There's a lot of properties that have very high delinquency, very high
Mm-hmm.
vacancy, and they're on the struggle bus across the board. So those areas could have further downside. We're seeing a lot of strength in, again, Class B and up. Kind of that almost like flight to quality, flight to safety. That's where capital wants to be. And when you're dealing with a higher income demographic, they tend to be a little less sensitive to inflation and have a little more room in their budget. So they can adapt a little bit more to
Mm-hmm.
economic conditions. And so right now, and yes, and everyone talks about the wall of maturities and all that. Yes, there is some distress. There's going to be some forced sales. I do not expect that to be enough to meaningfully move the market. Because number one, all of that, most of that stuff, not all of it, most of that is syndicator based, right? It was the whole we didn't have a multifamily bubble. We had a syndicator bubble back in
Yeah.
2021 and 2022. Like every,
Right.
10,000 people a day graduating from boot camps and just buying anything and like fighting against each other to buy these things. And as much press as that gets, it's actually a pretty small chunk of the overall market. I mean, the U.S. commercial real estate market is massive. So number one, it's not that big. And then you always see this stuff circulating. Oh, this many billions of loans maturing, this many billions. Yeah, but a lot of them are low leverage. A lot of them are performing just fine. A lot of them are in good markets. A lot of them are with healthy sponsors that can afford to pay it down a little if they need to, right? So not all of that is going to become a foreclosure. With all that
Yeah.
said, there is some, but that is an opportunity for the next 12 to 18 months to get into kind of before the next big cycle starts with increased rent growth and again supply demand imbalance. And then also I haven't updated the numbers in at least in a while, but the last time I checked, there's something like $6.3 trillion sitting in money market funds. Well, just for reference, Japan has the fourth largest GDP in the world, and their GDP is less than the amount of money just sitting in U.S. money
Just
market
sitting.
accounts, right? So, especially if interest rates do come down, that money is going to want yield, and commercial real estate is one of the best places, especially multifamily, because you can't be replaced by AI. All right, some people have to have a place to live. And then with the new tax bill that was just passed, you have 100% bonus depreciation. You have Section 179 expenses, which basically just in English means you can write off the cost of a refrigerator or appliances like the day you buy it. You don't have to like spread it out over 5 or 7 years. So that, I mean, the tax benefits are now, huge for any type of commercial real estate. And then on top of all of that, I'm sure everyone's heard of, KKR, Blackstone, BlackRock. We raised a $10 billion fund for distressed assets. None of
Mm-hmm.
that distressed assets have shown up yet. That money's still sitting there waiting, getting stale and anxious. So the whole point of that is we do anticipate some more distressed volume coming in, but there is also pent up demand for those assets, and it would have to really hit the fan for supply of deals to overwhelm the amount of capital that's out there seeking for it. And actually, that the everyone focuses rightfully so on interest rates because on when they're trying to value commercial real estate. But what is actually a more important determination of pricing and how commercial assets trade is market liquidity and capital demand. That actually has a stronger effect than interest rates. So, and there's a ton of capital out there, and there's probably going to be even more as governments print it. So.
Yeah. How do you measure that or benchmark that? Like interest rate, we can go look it up. It is what it is. But how do you measure that capital demand?
Yeah, I don't have a clean answer for that. So I just kind of like all those data points that I just threw out. I just kind of like mentally make note of that. Like, dude, there's
Yeah.
6 trillion in money market. Blackstone has just raised another 10 billion fund and they haven't spent it yet. Just
You can
all
kind of
those
connect
kind.
the dots for
Yeah, and
yourself.
then just talking with other operators who like, yeah, I've been
Yeah.
trying to buy a deal for, I've got this much money, and you just kind of get a general sense of where the market is. I actually spend a fair amount of time trying to focus on macroeconomics because all the little stuff can be noise. Like, oh,
Hmm.
this week's job report or whatever. Yeah, it's important, but macro picture is what's really going to drive things, and so I try to pay attention to that. And that's part of that is like, well, how much money supply is out there, how much capital is looking for yield, and where's that going to go? So
Yeah. Okay. I dig it. I dig it. Andrew, I'm curious to know from your perspective, because you've seen a lot of deals, you've done a lot of deals, you rub shoulders with people doing deals. Where do people go wrong? Where do they totally just fall on their face when they're jumping into the multifamily space?
there's a lot of ways, one of which we already talked about is buying rough properties in rough areas. And that's not, you
Hmm.
cannot take a property and you can lift, you can increase this, you can bring a property up, but you can't bring it above the neighborhood. The neighborhood will pull it back down. So don't ever make
Right.
that mistake. Um, but where people go wrong is, and it all kind of ties, is number one, making overly optimistic assumptions. So,
Mm.
every time you hear someone get on a podcast and say that they underwrite conservatively, if you turned that into a drinking game, you wouldn't make it through the end of most episodes. Like every time someone says the word conservative, right? And no one
Right.
defines what that means. So you have to define what that means. How we define it is, if we're inputting something into our underwriting, that could be exit cap rate, it could be rent growth. So you pick your metric, whatever
Hmm.
goes in, expenses, or a conservative number to us means that we feel like we have at least an 80% chance of hitting it. So to give an example, if the forecasted rent growth in a market we're buying in is 4% for the next 5 years, we're going to underwrite to 3% because, well, if the market, first of all, no one really knows what rent growth is going to be 4 or 5 years out the road, right? And anyone
Right.
who says they do is either on something or lying to you. And
Right.
then, but if the forecast is 4% for the next 5 years, there's good reasons for that, you're assuming, and you're going to verify that. But then it's like, yeah, but if I put in 4, then I got 50-50 odds. Well, if I go at 3, I can still be off by a big chunk and hit my numbers.
Hmm.
So again, and it's not like an Excel formula. It's okay. I feel, if the forecast is 4 and I'm putting in 3, it feels like I should have at least an 80% chance of hitting that, right? And insurance, I mean, everything that you put in, that's concern is going. You take your base case. I think this is going to happen, and then give yourself some cushion on everything.
Hmm.
And then if the deal still makes sense, again, your odds of winning are really, really good. So that is definitely, that's a big one. And, oh shoot, the second one, I got fired up, and the second one slipped my mind now. So maybe it'll
It'll
come
come
back
back.
later.
It'll come back to it. It'll come back to it. I mean, you brought up insurance, and I'm so glad you did. And you also mentioned that you invest out in Florida. So I'm
Hmm.
curious, like, how are you weathering that storm?
Literally very well. In 2018, Hurricane Michael came through Panama City Beach area. We had 150 units there, and in 3 hours, we went from 100% occupied to 10% occupied, because it took out 139 of the units, and basically just wiped them out. 155-mile-an-hour winds. But we knew that was a risk. We had the proper insurance, and ended up rebuilding the property from the studs in. That property it was built originally in 1987. Now it's effectively built in 2019 to 2020. That is the most profitable property we have ever owned. Right.
I
So,
love it. I love it.
you know, now would I want to have to go through the headache of rebuilding something for 2 years? No, but at the end, we came out so far ahead financially than if that hadn't happened. Again, we're making way more than we would have if that storm hadn't happened. So number one, if you properly insured, it actually can work out to your benefit. And that's the key thing is when is of risk mitigation is you got to identify like what could take me out of this game, and then can I mitigate it or eliminate it? And if the answer is no, you don't do the deal no matter how good it looks on a spreadsheet. And then if the answer is yes, then it's like then you start looking at what the upside is. So it's actually worked out great. We've owned on the Florida coast now for 9 years. Had plenty of storms go through. That was the only one that did anything really, really big. And again, it worked out fine. If you're buying in Florida, you do need to, budget for, potential insurance increases. However, with that said, the insurance market cycles just like any other business market. So some storms happen, some carriers leave, premiums go through the roof. Now the carriers are making a ton of money. Other carriers say, wait a second, they
We
come back
want
in.
in.
We've
Yeah.
actually, the last 2 years in a row, we've had decreases on our insurance premiums in Florida, right? So, and
Amazing.
then now, as I talk to people in the insurance industry, they're like, yeah, unless we get just an absolutely bonkers, year, rates are probably good where they are for the next 3 to 5 years. And it's not like, oh crap, one hurricane just hit Florida, and now the rates are going to go shoot back the roof. That it doesn't work that way. The insurance companies underwrite. They plan on a couple $1 billion hurricanes a year. So as long as you don't get
Hmm.
more than that, insurance rates are actually going to stay fairly similar. So I'm not saying it isn't a risk. It's just there's an insurance cycle, just like anything else. You need to kind of know where you are in that. Give yourself some cushion. Say, hey, if I'm saying my insurance is going to be $1,000 a unit, maybe I'm going to budget at 1,200 just to be safe. Give myself again, kind of that 80% number, and
Hmm.
I wouldn't shy away from a good deal just because it's in Florida. Now, with that said, would I want everything I own to be in a coastal city anywhere in the U.S.? Probably not, right? Because you don't want to have everything offline at once. But yeah, so
I love it. I love it. Well, Andrew, I want to get you out of here, but I want to ask you one more question. Because you went from the single unit flipping and owning to now the syndicating a deal, I mean, do you recommend that people go do that who are just getting started, who want to get into multifamily, or is there an interim step that you like to see folks go through?
yeah, actually, I think that's a good point. That's a common misconception of, oh, I got to start in single family first and then do multifamily. And I think part of that just comes from the fact that that's what happens, right? Like I didn't start with like, okay, this grand plan of going into multifamily. I'm just like, hey,
Right.
if I flip houses, I can quit my job. And then, after a few years of that, I'm like, okay, this is worse than my job. What's better? Multifamily. So, I mean, it wasn't like I had a grand plan. If
Hmm.
I were starting off today, I would go straight into multifamily. But if I was someone who literally had no experience, I would probably start with like a 4 unit to a 10 unit in my local market. You
Mm.
know, be that terrible investor I mentioned in the beginning and be involved in the day to day, because
Yeah.
doing that for a short period of time helps you manage the managers down the road, right? Like the more knowledge you have, it's easier to delegate a role once you've kind of done the role and understand it, because then it's harder for someone to fool you about what's needed. So if
Hmm.
I were starting today and let's say I can't go do 100 units, I would probably go buy an 8 or 10 unit, maybe even here in California, right? Just so I can get that experience, get a track record started, and then move on to the bigger stuff and use third party. Another thing to do is partner with somebody. Like maybe you can raise money but you don't have experience. Go partner with somebody who has experience, or vice versa. Maybe you have the time and skills to put in the sweat equity and do the work, and somebody who has the finances or can bring the finances. Do that kind of partnership, and then do it that way. But again, I'd probably if I was starting today, I wouldn't do the single family. I'd just go straight into smaller multifamily and then scale up from there.
I dig it. I dig it. Well, Andrew, this has been a ton of fun, man. Really, really insightful. If people want to reach out, learn more about what it is that you guys are doing, where's the best place for them to do that?
Yeah, I'm not a social media guy, so that won't work except for LinkedIn. I do
Okay.
post on LinkedIn. That is me personally posting and commenting. It's not a virtual assistant or AI bot or anything like that.
Awesome.
So if you connect with me there, that is me. And then if you just search, as my kids would say, search up Vantage Point Acquisitions, our website will come up. It says vpacq.com, and there's a couple of tabs on there for how to connect with us or set up a call or something along those lines.
Okay, good deal. Well, Andrew, thanks again, man. And hopefully we'll see you out in the water or on the slope sometime soon.
All right, take care.
Likewise, be good. All right, everyone, that was our show. A big thank you to Andrew for coming on. Super, super great take. Refreshing to hear from Andrew about what it is he did, how he did it, and how you can do it too. As always, we love hearing from our audience members and listeners. Ratings and reviews are super helpful for the show, and we'd love to hear about what it is you want to hear more of or less of. We look forward to seeing you on the next one. Happy investing.